Hello everyone, Steve Lentz here with Discover Options here at Option View Systems. Welcome to this presentation of three different market timing reports for the S&P 500 for advanced options traders. This will be for Friday, February 9th, getting ready for Monday's open on the 12th. Presented materials for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get started, if you could please subscribe, just click the button, subscribe. That way you get alerted whenever we come out with new videos. And also, we have a free ebook. For those of you that have not yet received this, just click the link, give us your information, and we will get this out to you. Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. The market action was obviously crazy last week, and Monday's action, if you watched last week's edition of the reports, Friday's action had only occurred about 7 times in the past since January of 2000, and at no time did Monday's action take place when we had that duplicate market action. And that really lends credence to the notion that when you only have seven incidences in the past, you can't really give it near as much weight as when you have something like 10 times that much. So, what happened and where are we? Obviously, the market went down dramatically. We are now below the 50-day simple moving average. The current market condition can be described as this. We're below the 50-day simple moving average, so the trend is down. Friday was a downswing bar that occurred after a previous downswing bar, lower highs, lower lows. But here's what makes it kind of unique in that Friday's close was higher than Thursday's close. So even though you have two downswing bars, the close on the last day, on Friday, was higher than the previous day. So that makes it kind of unique. Without that qualifier, this definition of the current condition would be over 300. Now we're cutting it down to about 82. In terms of the stochastics, we are between 0 and 40 in the lower end, and we are trending underneath the 3-day simple moving average, the percent D. So again, this market condition has occurred roughly 82 times in the past since Jan of 2000. Now the one thing missing here is the average true range. And that is that's another element of this market condition. However, when you go in the past, you just don't have the market condition having it such where you have average true ranges. The true range of each day being at 100 points in the S&Ps. It's been crazy, and so that part I'm leaving out so that the population of items of past incidences is at 82. If we were to throw in that average true range, I went back and looked at just the past 5-10 years. I mean, it has not been this high from a percentage basis, much at all. Nothing approaching this. So this is very unique in terms of the history. With that said, let's go ahead and plow away. Let's go to the Condor and Butterfly timing report. So since Jan of 2000, we've had 4,570 closes of the SPX. Of these, 65.1% have been favorable bars for selling options premium, where the actual 21-bar movement was less than what was being implied by the option prices, by the SIBO skew-adjusted VIX. Now, also during that time, since Jan of 2000, our current market condition has occurred 82 times, like I mentioned. Now, of those 82, look at this, 43.9% of the bars have been similarly favorable for option premium selling. That's not very much. That implies a selling edge that's negative by 21.2%. That's about as high as we've seen in the years I've been doing this report. So statistically, it's more likely than usual by quite a bit that the current market condition that ends up on Friday will end up being an unfavorable one for market neutral option premium selling. Now, folks, that's even including the fact that implied volatility is blasted off and you can get some fat premium. All right, because even in that environment, what we're seeing is that statistical volatility, the market has a tendency more often to move more than that implied amount. So be very careful, have some adjustment strategies in place, and if you need help with those, you can certainly look at our mentoring program, which have some great rules for putting on butters and condors and maneuvering around as the market moves. Okay, now for the bull put spread timing report. This is for those that sell premium by by selling puts, primarily out of the money, about a standard deviation 30 days out or so. That's the premise here. And as I mentioned, we've had 4,570 daily closes of the SPX. Now, of those, 83.3% of the time, okay, those end up being favorable, where the actual downside movement over the next month, 21 trading bars, was less than what was being implied by the option prices. That is the SIBO skew adjusted implied movement using the VIX. Okay, now also during that time, our current market condition occurred 82 times. Of those 82 times, let's see, boy, it's kind of small. 68.3% of the bars were similarly favorable for put premium selling. Now that's quite a bit less than the 83. Okay, so this implies a put premium selling edge that's of minus 15%. Again, statistically, it's more likely than usual that Friday's bar will end up being an unfavorable one. The current market condition is an unfavorable one for selling out of the money put premium. Is it a guarantee? No, but we know that by looking at the past of those other 82 incidences of this general price action in this environment, downtrend with the stochastics low and trending down, that this is an unfavorable situation for selling put premium. You could do it and still make money. There's a 68.3% chance that you will, but there should be just the baseline is 83.3. So you're going against the wind here a little bit. So that's it for the bull put spread. Let's go to the market likelihood report, and this answers the question based upon past occurrences of our current market condition. Where should the market go? Up, down, or wobble around for a bit? And so to answer that question, we use distribution bands, and I'll explain that and then come back to this report. So distribution bands are these right here. What we do is we go at a standard deviation above the close, a standard deviation underneath the close. These are 5-day bands, so we go out 5 days. And we're going to note over the next 5 days whether price goes up and strikes the upper band or the lower band or wobbles around and hits neither of them. Okay, and we keep that record for every close going back since Jan of 2000. We do this not only for 5-day bands, but also 10-day bands and also 15-day bands, so we get a good distribution sense of where price goes. Now, let's go back to the report. If you were to look at the last 4,570 closes of the SPX, the upper 5-day band gets struck 21.9% of the time. The upper 10-day band, 16.4%. The upper 15, 15.7%. The lower 5, 16.4%. So look at that. The lower 5 is struck 16.4%. The upper 5, 21.9%. 21, let's call it 22, 32, that's about 38%. Okay, the rest of the 61%, the other 61% of the time or so, over the next 5 days, it does not hit either band. You see how that works? The lower 10 is at 16.6, the lower 15 at 19.4. Now, let's go to the, and this is 83 is including our most recent one. We have 83 occurrences of our current market condition. Of those 83, the upper 5-day band was struck 24.1% of the time. That's more than the baseline. The upper 10-day band was struck 22.9%. Okay, that's more than the baseline of 16.4%. The upper 15-day band 21.7 is more than the baseline. In fact, for all three of the lower bands, you can see that those are struck more often by a significant amount than the baseline over the whole history since Jan of 2000. So this is a picture of increased market volatility, both to the upside and the downside, in both directions. Wow. It's been a while since I've seen this. Now, we also carve these 83 up into situations where the market goes above Friday's high and exceeds the previous day's high, in this case Friday's high, and also where it goes down below Friday's low. So of the 53 times it exceeded the previous day's high, Friday's high in this case, you can similarly see all 6 bands were struck more often than their baseline levels. And if price exceeds the previous day's low, Friday's low in this case, again, all 6 bands getting exceeded, exceeding the baseline statistical count. Clearly, a picture of increased market volatility relative to the past. No real directional bias here. If we had all the green squares with red numbers, all right, we would lean bearish. If it was the opposite, and the red were blue and then the green were red, then we would be leaning bearish. But this is just one big blob of explosion in market volatility in both directions over the course of these 83 incidences. All right, so that's it for that report. Folks, good luck trading this week. I'm Steve Lenz with Discover Options. We'll see you next time. Take care. Have a great rest of the day. Bye-bye.